Hey, how we doing, everybody? Welcome to SPACs. Wait, is it lefty or righty? I don't know. I'm a lefty. Mitch might be a righty. SPACs attack. Spencer Israel filling in for Mitch one last time. He'll be back in the driver's seat tomorrow. I'm here with my man, Chris Katje, a.k.a. Chrisopedia. Chris, how's it going?
It's going good. How about you, Spencer? Thanks again for filling in here.
We got a busy show today. We got our guest segment coming up in a few minutes with Emil Michael, who's from DPCM Capital, and the company that they are buying, Jam City. The CEO, one of the founders, Chris DeWolfe, will be on joining us in about 10 or 15 minutes, talking gaming, mobile gaming, social gaming. I'm really excited for that interview. But we got a lot of news today, do we not, Chris?
Yeah, we got two deals announced today, too, to talk about, Spencer. So, we're starting to see breathing coming back into SPAC land with deals being announced almost every day now. So, for a while, it was I could wake up, see no new deals, and now we're getting deals every morning. So, exciting times out there in SPAC land again.
All right, let's take us behind the headlines, won't you, Mr. Katje?
All right, guys. So starting out, one of our biggest movers yesterday, we talked about on the show was QuantumScape, QS. Now, I did see that they actually had an event yesterday where they discussed battery innovations for mass adoption of electric vehicles. So again, QuantumScape, one of those companies out there, went public via SPAC, doesn't have a product out yet, couple years away. But this is a hot one, and no surprise that it was up yesterday as investors got some more insight into their future and future projections. So keep an eye out on QS to see if that movement can continue, over the next couple days and into next week. Then former SPAC E2 Open, that's ticker ETWO. They announced this morning that they will acquire Blue Jay Solutions for $1.7 billion. So E2, this is one, it's trading up 4% today. We're over $13. This is one that's traded around, the $10 level for a while. Didn't get huge excitement post-deal. It's an end-to-end and cloud-based supply chain management SaaS company. So it's an interesting one. And now this acquisition, maybe bringing a new story to the company going forward. So keep an eye out on ETWO going forward. And then we have Blade, BLDE, Blade Air Mobility, entering into an alliance with Magnix for the electrification of Seaplanes for urban air mobility flights on key Blade routes. So remember Blade, they have that electric vertical takeoff and landing that they're actually doing at several airports later this year. And now they're getting a new partnership announced today. So keep an eye out on this one. We've got several companies in the eVTOL space. And, Blade has had lots of news recently since completing that SPAC merger. Then earnings last night from Matterport, a company that's merging with GHVI. So first quarter earnings, they saw revenue of $26.9 million. That was up 108% year over year. Subscriber revenue, $13.8 million, up 84%. Annual recurring revenue now hitting $55.2 million. Subscribers, 331,000 at the end of the quarter. That's up over 500%. They also talked about expanding into South Africa and the Middle East through relationships with resellers. So remember I said on the show yesterday, one of the things to look forward to with the earnings was that they had made a couple recent hires to expand their international business. And, that was definitely a highlight of the earnings last night. Shares were up, 3 to 4% this morning. It looks like we're fading a little bit now, up 1%. This is one that's gotten some love on CNBC. I know Josh Brown has called this one out a couple times, in that earnings report, huge growth, triple digit revenue growth, and, subscribers up over 500%. So keep an eye out on this one. And SSPK setting a merger vote date of June 10th for their merger with Weedmaps. So we add that to the calendar, which is already, filling in nicely for the month of June. Then our two deals yesterday, FORE shares ended the day up 2%, and DCRN shares ended the day up 1%. So another day of deal announcements ending the day positive. That's nice momentum to see. And then CCIV shares down 1.4% on the day. It looks like that presentation yesterday. You can see on the chart there, shares hit their highest point of the day right around the time of that presentation at 1 o'clock or going into it. And then they started to fall shortly after, as again, as I said, there wasn't really any new news. There was rumors that, they'd announced some big partnership, maybe a deal with Apple. But, ultimately that wasn't the case. So this just turned into, another presentation to show off the vehicle and hit on some stuff going forward. And we do have our deals, IPOE, the merger vote today, and STIC, the merger vote tomorrow. So keep an eye out on both of those. Spencer, were you going to jump in?
No, I was getting ready for the good stuff, which is
okay.
The deals.
I thought I heard you ready to go.
Well,
All right.
Yeah, you did, but I thought I'm ready for these deals, baby. Let's go.
All right, so let's turn to our deals. So up first, we have ticker PACX. This is Pioneer Merger Corp, bringing Acorn Group public, a financial industry savings and investing app, valuing the company at $2.2 billion, including an oversubscribed and upsized pipe, expected to close in the second half of 2021. Interesting to note that Acorn CEO Noah Kerner plans to contribute 10% of his ownership into a new program, giving shares of the company to eligible Acorn customers, and an additional 10% ownership from some of the sponsors will also be added to part of this program. Investors in Acorn include PayPal, BlackRock, and celebrities Ashton Kutcher, Jennifer Lopez, and Dwayne "The Rock" Johnson. So founded in 2014, Acorns prides itself as being a category creator and category leader. They offer subscription-based services for newer investors. So $1 a month, $3 a month, and $5 a month are the current subscription offerings. They're the largest subscription-based service for financial services with more than 4 million members. Their churn rate only 1.3%, and after 12 months, 80% of the company's subscribers are retained. Growth ahead, they want to hit 10 million members by the year 2025 with a massive total addressable market. Their customer base also changing. It used to be where the majority of people paid that $1 a month. They are now seeing where more people are upping to the $3 or $5 a month subscription offering. And then they're also going to expand their pricing tiers. They're going to offer ESG portfolios, smarter banking services, and portfolio customization going forward. So revenue $71 million in 2020, guiding to hit $126 million in 2021 and $245 million in 2022. Gross margins of 80% and subscription services hitting 79% of total revenue. Shares of this one were up, decent on that deal. What do you think, Spencer? It sounds like you know a little bit about Acorns.
Yeah, well, just one in chat if you've used Acorns before. I'm just curious because I've always thought like of all of the modern investing apps, whether it's a trading app like Robinhood or a robo advisor like Wealthfront or Betterment or whatever, or a platform like Acorns, I've always thought that the idea of Acorns is amazing, right? Basically, you invest your spare change, right? You pay $4.60 for a cup of coffee. Round up the extra 40 cents, invest the extra 40 cents, and it adds up over time. It's a great idea. Invest your spare change. But I've never actually, I've heard of people using it. I've had friends use it, but I've never actually heard of anybody that's like had a lot of success and been able to build some wealth through the platform. So I'm just curious. A couple people in chat say they've
seen a couple ones, yeah.
And if you have, great, fantastic for you. I think the concept is amazing. Invest your spare change because we all have spare change. We all just kind of throw it away or throw it, under the couch or whatever. But I've never actually heard of it. I'm sure there are people out there that have had amazing success. So I'm just curious if any of our viewers have Great. That Cam guy says every few months he transfers his Acorn balance into his crypto account, which that's fantastic. So I guess it's working for you. Great. I've never used it myself. I'm just very curious to see, because I've always thought the idea is ingenious. But I've had several people say, yeah, I tried it and it didn't really work for me. So
Spencer, there's your growth right there from that Cam guy. How about if Acorns in the future makes it to where you can put your spare change into crypto?
I don't know if they don't do that now. Maybe they don't.
It was not in their presentation. I didn't see anything about crypto in there, but holy cow. I mean, what a great idea that would be. But the thing that stuck out for me, Spencer, is, right now they have the $1, the $3, and the $5 offerings. They're going to offer more services, more pricing tiers. And then right now, you have to kind of select from their portfolios that they already have. And in the future, they're going to make it to where you can kind of customize and also some ESG offerings. So I think maybe that could bring some more subscribers. I know the thing for me, I've never used it, but I've seen the ads before. I've seen Ashton Kutcher talk about it. He talked about it on one of the talk shows he was on. He's done ads for it. So good brand awareness there too, with the celebrity backing.
Yeah, I don't know like what I've searched for on Twitter, but for some reason Twitter has decided that like they really, really, really want me to see Acorns ads. I see ads for Acorns every day, probably twice a day.
And you're gonna see more now that you're saying it out loud on the show. So
I have done that. That was a mistake. All right, we had one more deal, and then let's go to our guest segment. What else do we have this morning?
All right, so our other deal announced today, we have ticker LWAC, Locust Walk Acquisition Corp, bringing EFFECTOR Therapeutics public, valuing the company at $419 million. A $60 million pipe also includes investments from Pfizer. So this is expected to close in the third quarter of this year, trading as EFTR on the NASDAQ. So EFFECTOR Therapeutics is focused on selective translation regulation inhibitors to treat cancer. So this is going to help them bring that pipeline to life here. And LWAC CEO said that their targeted translation regulation could have the potential to address multiple drivers of cancer. So they're taking a therapeutic approach, treating where tumors have hijacked to preserve normal cell function. They do have a global partnership with Pfizer for some future development. So keep an eye out on that. Remember, as I said, Pfizer investing in the company here. They're also going to expand their lead candidate, Zotadefin, into antiviral therapy for patients with mild to moderate COVID-19. So some COVID-19 trials upcoming as well. And they'll present top-line data for a phase 2B Kickstart trial in the future, partnered with Keytruda, the drug from Merck. And then they're also going to expand into more 2A trials in the second half of 2021 for additional indications now with that funding. So LWAC and Spencer, I got to highlight, this was an exclusive to Benzinga. So we had this deal out on Benzinga Pro this morning at 7:30 a.m. Eastern time, an article out on the website as well. Shares halted at 7:48, and that official press release came out at 8 o'clock a.m. Eastern time. So if you're a member of Benzinga Pro, you heard all about this deal before it was even confirmed by the company. So Spencer, got to plug Benzinga Pro here because it's where I get my news. But this morning I was able to help contribute news to it, and we were able to get this deal out to our members. So
right where my mouse is on the screen, that's 7:30. That's when the news hit our wire, and you can see the spike right after that. And while Chris mentioning Benzinga Pro, I want to mention the special we're running. Free or not free? What am I saying? Well, you get a free 2-week trial, but if you want your first month for less than $10, you can enter the promo code 30days 30days pro.benzinga.com. Get the first month for just under $10. All right, Chris, those were our deals for the day, right?
Those were, two big deals. And again, Benzinga with the exclusive, and Acorns, a company that most people have heard of. So big day out there.
Big day. All right, let's deep dive. Let's unlock a SPAC with our guest coming up right here. All right, joining us now are Emil Michael, the CEO of DPCM Capital, and Chris DeWolfe, the CEO of Jam City, the company being bought. Emil, Chris, welcome to the show.
Good to see you.
Thanks for having us, guys.
Hey, guys.
Thanks for coming on. Chris, I'll let you take it away.
All right, so I'm going to dive into some questions here. Going to try to get questions, for both of you, but feel free to jump in, if you have anything to add to, a question to the other person. So I'm going to start with you, Chris. This is SPAC's Attack. We talk all things SPAC here. So the big question out there, is why a SPAC deal to bring Jam City public, and was a traditional IPO, a consideration as well here?
Yeah, everything was definitely a consideration. And as you may or may not know, like a core part of this deal was an acquisition where we're buying Ludia Corporation, which is one of the most creative gaming studios in the world, and one of the largest in Canada. And so when we began talking to them last year, we were also talking about how to take the company public, and in kind of finding a way to bring the two together at the same time. The SPAC was just the best vehicle to do so, to close both at the same time.
Perfect. And then, Emil, so you have this SPAC here that we've got thousands and thousands of private companies that you could choose from, and you landed on Jam City. So what were the big reasons that Jam City ended up being the company that XPOA is bringing to the public markets here?
I mean, a few reasons. Number one, we wanted to pick a real business, right? And if you looked at what happened in the last quarter with SPACs and pipes and all that, the companies that have had the hardest time getting through, or whose stock prices have dropped, of those that have been projecting revenue starting in 2025. So Jam City has real revenue, hundreds of millions of dollars in revenue, cash flow positive, on the cusp of material profitability. So that was design point one. Design point two was a founder-led company that still had the passion and fire to go for a long time and wasn't just looking to cash out. And that's the definition of what Chris has built. And then third, a growing total addressable market. There are 2.7 billion gamers out there today, growing. And they spend about 45 minutes on some of Chris's games at Jam City. 45 minutes rivals the amount of time spent on Instagram, YouTube, all other media apps on your phone. So those three things combined are why we were glad to be selected by Chris and his team.
Perfect. So I'm going to turn back to Chris here. I'm sure some people listening out there, they may not be familiar with the Jam City name, but perhaps they've played some of the games. So we have Harry Potter, Hogwarts Mystery, Cookie Jam, Panda Pop, Disney Emoji Blitz. Give us the background on what Jam City is all about.
Chris, you're on mute there. Unmute your microphone.
Jam City creates super premium games that are massively social, and they're really built to be played for many, many years. So another way of saying it is we make incredibly deep, rich, entertaining games that people will play for years, if not many decades.
Perfect. And then, Chris, one of the things you mentioned was the acquisition of Ludia being part of this deal. So Jurassic World mobile game. I know that one of my sons actually plays this game. So I have seen it firsthand. So tell us more about Ludia and what that brings to the table going forward.
Yeah, it's a really interesting acquisition for us. Jam City has been a very unique company in that we've been able to grow both through organically in developing great games in our own studios, and also growing through acquisition. So there's a lot of companies in the mobile gaming space out there that either grow way more through acquisition or just organically. We've done a great job of doing both. So over the last 3 years, we really wanted to prove out our ability to be able to acquire companies, create a lot of value by increasing all major KPIs, and then do it again. And so as we've had this track record of acquiring companies, integrating them into the company, we spent a lot of time with Ludia, and they're a company that is incredibly creative. They build deep, rich narrative games. They have a location-based game using AR and VR, which is incredibly exciting, which is, I think, the one that your child plays. And they're coming out with more interesting technology just like that. So they are similar to Jam City in that they have a value on premium products. Number one, we have a very similar corporate culture, and they give us more scale to be a public company.
And then Emil, you mentioned, selecting Jam City because, you wanted a real company, real revenue, but also, you got to look to the future. So, we have this exciting game pipeline kind of laid out by Jam City here in the presentation. We've got Disney, we've got DC, we've got HGTV, Star Wars, and Avatar. How much did this pipeline really play into, getting a deal done here and growth going forward?
Yeah, I mean, the pipeline is really important to this business. And one of the key things is a scaled gaming company like Jam City that doesn't have just one title but has a lot, has way more predictable revenue and profits, right? Because no one title is a majority of the business. So the fact that they already have the titles they do and are adding this many means that you can almost think about it as a subscription business. And that's pretty attractive because the big gaming companies like Zynga and so on are thought of like that, or the small ones are thought of as a little more hit-driven businesses. So that's one of the reasons when you look at these titles, like, holy cow, these things could be explosive and really blow through any projections if they catch fire.
So you said I could jump in.
Yeah, go ahead. I was going to ask you about this pipeline anyway, so jump in. Maybe give us a little color on when we're going to hear more or see more about these games, because this pipeline looks incredible, Chris.
Yeah. I think Emil hit a lot of it right on the head. Just to explain the business a little bit more, we have 7 what we call forever franchises, and each of those games has generated 100 million or more in lifetime bookings. And that portfolio of games really makes up the bedrock of our revenue. And so how we grow, that portfolio is growing. And how we grow even more is we take these new games that are in our pipeline, which we believe is the strongest pipeline that we've ever had in our history, and we believe it's one of the strongest pipelines in the industry. So we take these games plus our acquisitions, and then we stack them on top of our forever franchises, in which we have 7 of them. And that's how we get our growth. But as Emil mentioned, it's really the 7 forever franchises that we have that make our revenue very durable year in, year out, and create almost like a subscription-based sort of an analogy for our business.
So, Chris, one of the things I noticed is, kind of a split revenue between the owned games and the licensed games. That pipeline looks like a little heavier on the licensed side of things with Disney, DC, and HGTV. What's the strategy going forward with balancing between, owned games and licensed properties going forward?
Yeah, another really unique thing about Jam City is that we have a fairly equal mix between owned IPs, meaning intellectual property-based games that we've created in-house, and then third-party intellectual properties and franchises that we've licensed from the largest entertainment companies in the world, which you mentioned many of them before, like Disney, Warner Brothers, NBC, Universal. And having that mix is critical. And let me tell you why. So I think what you're showing right here is Cookie Jam, which is one of the games that we've created from an in-house IP that we developed. And the great thing about this game is, like, if you look at 2020 revenue here, 80% of the revenue in this game was generated from people that downloaded the game in previous years. So what that means is our games are built to last for many, many years. That's how they're designed. In addition to that, when we're building in-house IPs, we have a lot of flexibility to create bigger franchises out of them. Like in the future, there could be, we haven't modeled for this at all, but there could be adjacent revenue streams in whatever form that they want to take. The third-party licensed IPs are incredibly interesting as well. You look at a game like, Harry Potter, when we launched that in 2018, went to #1 in 40 different countries. And so the great thing about these games is there's a massive fandom around the property itself, and these super fans want to try basically they'll sample any kind of any kind of game or movie or TV show that has to do with their favorite IP.
I just want to follow for a second. Chris, can you speak a little bit with regards to both those business models, and which accounts for a larger piece of the pie and which is more of a growth driver going forward?
They're pretty even, and they're both important. I would say the third party licensed IP that we take and then translate into a wonderful mobile entertainment experience is great because it brings a lot of players into the game very quickly. So maybe it gets out of the gates a little bit faster.
Cool.
And we're paying, a licensing fee for the use of that property. But we're getting also more organic users coming into the game. So we're spending less on marketing. So it becomes somewhat substitutional for marketing.
Got it.
Does that make sense?
Yep.
Okay. Want to make sure I'm not getting too wonky on this. And then for our own intellectual property, again, it builds up a little bit slower over time, but it gives us a lot of flexibility in the future to develop other cross-platform games and potentially other spin-off games from those brands that we develop and we own. So both models are really important and really unique to us as a company.
Perfect. So, Emil, I want to turn back to you. You mentioned, the huge growth of gaming. I'm wondering, was mobile gaming a focus area of this SPAC from the start, or did the huge growth we've seen during the pandemic, play into maybe putting more of a focus on mobile gaming being a target area?
I don't, Chris will tell you, I don't think that the pandemic changed behavior in terms of the amount of time people were spending on games. So this is the amount of time sort of didn't change, which is actually good because that means you're not expecting a downturn when the pandemic's sort of fully over. But we, in my SPAC, targeted 4 areas: companies that were changing the way we lived, the way we worked, the way we moved, or the way we learned. And this is squarely changing the way we live because the amount of time people are spending on their phones with that computer in their pocket and specifically on games and media consumption. And that amount is extraordinary. And I think there's one chart that in this deck that has that. And we were just flabbergasted to realize that people are spending more time on Cookie Jam than they are on Instagram. And when you see that kind of attention, and you think about the advertising revenue streams that could generate, the new games you could promote, the in-app purchases, you really get excited when you multiply that by, what will be 5 billion gamers in a couple of years.
Perfect. And Chris, one of the focuses on the presentation, we have Jam City Live. Can you tell us a little bit about what Jam City Live is about, how big of a piece of the pie it is now, and what the growth looks like for it?
So it's incredibly important. It's the technology platform that underpins all of our games. All of our games integrate into Jam City Live. Jam City Live is a platform that uses machine learning, artificial intelligence, and data science to accomplish 3 primary areas, which you've put up here on the board. Player acquisition. So it helps us automate our bidding and buying process when we're doing user acquisition or player acquisition. And what I mean by that is in any kind of campaign that we may set out to run, there could be tens of thousands, or there could be many, many thousands of variables out there, from the type of creative we use, from where the campaign's running, to who it's targeted to what the individual game is, et cetera, et cetera. So having machine learning to be able to automate all of those processes and very, very quickly tell you which campaigns are working and that you need to increase your spend on, and which ones aren't working, which you need to quickly cut off, is the difference really between winning and losing and bringing more players into your ecosystem. So the first thing it does, Jam City Live does, is it helps us bring more players into our ecosystem. The second thing, it helps with user retention, and it customizes the player journey throughout the game, and it makes sure that, for example, in a game like Cookie Jam, where we have levels, that the levels aren't too difficult, where people get frustrated in the games, but they're not too easy, where they're not challenging, and you like are always feeling a sense of this accomplishment. And then finally with monetization, where we're able to do the proper merchandising to our players, meaning we have sales in our games, we have events in our games, and there are different stages in the games where different folks are. So for example, a new player may necessitate a certain kind of event, a certain kind of sale. And so the machine will say, you get this sale and you get this event. And so it creates just a much more customized experience where we're able to maximize our monetization. And so we spent the last 10 years building Jam City Live, tens of millions of dollars. And this is a technology that the majority of companies are not even anywhere close to. And it primarily is what gives us a leg up in M&A. It's a huge advantage in mergers and acquisitions, because we're out there looking for those incredibly creative companies that have found the fun and the magic in the games, but they don't have this deep investment in Jam City Live and a technology platform that can greatly increase all of their metrics. And so that's really our secret sauce.
Awesome. And then a question for both of you here. You know, you mentioned M&A a little bit. So Emil, start with you. You know, it looks like Jam City, you know, a history of M&A and being successful. Obviously, we've seen the video game sector, you know, ripe for mergers and acquisitions. How does Jam City position itself to be, you know, more of a acquirer versus a possible acquisition target down the road?
Well, if you look at the track record, which we did deep due diligence on the last several acquisitions they did, and you see where that company started and where they ended after getting put into the live ops platform, the gains were extraordinary. So to me, that says that they have the technology to be the acquirer, and now they have the scale and the public currency. So I think Chris made a smart decision to say it's time for the company to go public, because they have figured out the formula for acquisitions. Now they have the currency to use stock or cash to buy these gaming companies and turn their financials into that are maybe, you know, have an X revenue and Y profits into X plus revenue and Y plus profits. And that's why I think they're going to be the acquirer of the future and one of the few big public gaming companies out there in the future.
I have a question, and this is really for either of you, whoever wants to take it. I brought up that chart just now that I think it was Emil who may have mentioned earlier, or may have been Chris, of this time spent on these games, right? And obviously, like the red there is very, very impressive. But also, if you took a chart of this and you went back a few years, and it would be littered with you know, mobile games of yesterday to an extent. I mean, you know, I still see Candy Crush on there, Words with Friends, but a lot of games have come and gone. How do you avoid that? How do you not avoid it, but how do you protect against it? You know, this is a very much a space of hot potato. You know, what's hot now may not be hot tomorrow.
Yes, so I mentioned the notion earlier of what we can call forever franchises, and those are games that have generated 100 million or more in lifetime bookings. So we have 7 of them, and really the goal is to design those games to last for many, many years. So all of those games have large dedicated teams that are constantly building new levels, they're building new worlds, they're building new features to keep the games fresh and fun. So players are playing for many, many years and decades. And as you can see, it's become, you know, really part of the fabric of their everyday lives, where they're spending 30 to 40 minutes playing a Jam City game, just as they would, you know, spending 20 or 30 minutes on Instagram or Snapchat or texting or watching Netflix or whatever it is they're doing. So as a true product company, this is really the holy grail. If you can build a great product that satisfies the need of your customer, and in our case, it could be one of many motivations. A lot of times it's just to relax and chill out at the end of the day, and maybe for competition, or maybe just to socialize with friends and family.
Perfect. I have a question on the financials here. You know, one of the things with the SPAC is, you know, you have to kind of give a couple years out. So, and this could be for either one of you. I'm wondering how much of the Ludia acquisition and possible growth for Ludia is priced in, and is any M&A priced into the future projections?
Yeah, so first of all, Ludia is priced in, and like I think you saw the numbers. 2022 is pro forma around 860 million, which represents 23% growth. EBITDA is around 115 million, which represents, I think, over 30% growth. So that's priced in. The future M&A is not priced in, nor are certain game titles priced in.
Perfect. And then a question probably for Emil here, and we also got it from the chat. With SPAC deals, we've seen a lot of them where the pipe gets priced at $10. We've seen several where the pipe is priced above the $10 range. According to this presentation, we have the pipe being done at $8.42. Can you tell us why the decision to have the pipe shares done at lower than $10?
Yeah, I mean, this last few months in the pipe market for every company that's been in the SPAC sort of pipeline had been extremely difficult from a pipe standpoint. So one of the strategies we used was, can the sponsors, which is my group, contribute to some of our sponsor shares to effectively make it a more attractive deal for the pipe investors so that we can speed the process up and get to the end state where we could talk about de-SPACing, and it worked. So we gave up a material portion of our sponsor promote, which effectively went to the pipe investors, and that's why you can get an effective price that looked like 842 as opposed to 10. And even at that price, it's a screaming deal in our view. At $10, it's still a screaming deal. The multiple on 22 EBITDA that the $1.2 billion implies, which is at $10, is 10.7. And when you compare that to Zynga, Playtika, some of the other companies that are in and around the gaming space in the market, it's an extremely attractive deal. And we just made it more attractive because we had to get through that hump of the pipe market that you guys probably talk about on this show all the time in the last couple of months.
We certainly have. One question from the chat, and then we're going to let you guys hop here. I guess it's a question for Chris. Are you doing any collaborations with Marvel at all? Or is it on their radar? Or I don't know if you can answer that. But
yeah, we can't really talk about future collaborations, but
is there any
obviously like Disney?
Any news about it that you can't talk about?
No, Disney is, you know, probably the largest IP.
Okay.
Definitely the largest IP holder in the world, and we have a very close relationship with them, and they've been a joy to work with, and we're going to be working with them in the future on different projects.
Okay. All right. I think that was it. Unless there was, let me go do one more pass through. All right. I think that was it. Chris, you want to wrap it up?
Yeah, you know, thanks guys for answering all our questions, and you know, yeah, we got that one from the chat as well. So again, guys, joining us on the show, Emil Michael, the CEO. XPOA is the SPAC, and Chris DeWolfe, the CEO of Jam City, the company going public with XPOA mobile gaming. Very exciting future. We look forward to following the progress of this company and hopefully talking to you both in the future. So thanks for taking time out of your busy schedules for joining us on SPACs Attack.
Thanks, Chris. Thanks, Spencer.
Thank you.
All right, that was a good one. That was a good one. Oh, wait, I didn't even ask Chris about MySpace.
I know. I thought about that. I was like, he is a founder of MySpace after all. So
Yeah.
I mean, Spencer, I've talked about mobile gaming for years. That this is a huge growth segment, and this was an exciting one to be able to do. And as I said, I've got kids who play a couple of these games. So it's nice to be able to connect with that as well. The Jurassic World game, I think they've played the Disney Emoji Blitz as well. And they have that upcoming pipeline, right? We've got a HGTV home game, and then we've got the Avatar, Star Wars, another Disney game, and like that question in the chat said, maybe some Marvel games in the future. I figured he wouldn't be able to say anything, but
he implied it.
He did, and they've got a strong relationship with Disney. And let's face it, Disney doesn't make many of their own games, right? They license everything out. So they're a partner here, so they could get a piece of that pie. So very interesting.
Yeah, that was a good one. Mobile gaming, obviously, like you said, is a huge growth segment. I don't partake personally. I don't need to be spending any more time on my phone than I already do. It's bad enough with social media and stuff like that, but you gotta, everyone in gaming says that the biggest growth driver is mobile. Maybe we could have asked about what's beyond mobile, like metaverse type stuff. There's talk about that, but that's down the line. But again, interesting what Emil said. I think it was Emil. Very few like real profitable companies like that out there. So
yeah. And to the point of, I loved your question about asking about games, right? Because the mobile games come and go. I mean, I'm guilty of that, right? I've played mobile games, and then you get sick of them, or you don't want to spend the money, and you delete them and you move on to the next. So the fact that he was talking about the Cookie Jam game, and where 80% of the revenue is coming from people who downloaded the game over a year ago. It looks like some of those forever franchises, at least still showing signs of monetization. So, and the key, I think Emil talked about too, I saw in the presentation, was that no game accounted for 20% or more of revenue. So it does seem like they're diversified. You see gaming companies all the time where they live and die by one hit franchise. So for a mobile gaming company to have, 7 forever franchises and that big of a pipeline, it looks exciting to me. I like the mobile gaming space. So Spencer, we do have a item to get to. We got to talk about
wait,
Chamath.
I just want to
go ahead.
Mahi in the chat, it was the one who asked about the pricing of the pipe, the question that we were going to ask anyway. And it's a fair point. It is a totally fair point. It doesn't make, I mean, I thought Emil's answer actually wasn't that bad, but it's sort of a thing that makes you go, huh? Why?
Well, and maybe it's the start of something too. For a long time, we saw all the pipes go at $10. Mm-hmm. And then we started to see several of them done above $10, right? Because there was such high demand.
Right.
So in order to get part of the pipe, you were having to do $12, $14, $15, like the Lucid motors. And now maybe we're starting to see the trend where in order to get some of these pipe investors to come on board, you have to offer, below $10. And I think some of the keys from Emil were that it sounds like that's coming out of them, right? And out of the money that they possibly could have made by offering the pipe at less. So it doesn't seem like Jam City's getting punished at all. It's the SPAC that's getting punished, but they were so excited to get this deal done that they were willing to, take the discount there. This is definitely a trend we need to watch, though, and keep an eye on, because obviously it does seem like a red flag to see it below $10. But to me, I'm just cautiously watching, and I really like this deal. So, looking at both sides of the coin here.
Yeah. All right, let's move on to the hot topic of the day in SPAC world, if there is one, is this op-ed from Mr. Chamath, Polyapatia. Chris, what did it say?
Yeah, so I mean, there's a ton in this. I'm going to try to highlight some of the keys here. So Chamath had an op-ed in Bloomberg, and the headline you see there is SPACs need more oversight and regulation. And we've obviously heard the SEC kind of discuss that as well. But he talks about how, IPOs and SPACs both are a bet on the future. Some will succeed, some will fail. And then he says that there was a lot of froth in the SPAC market in the first quarter of 2021. As of May 1st, 406 SPACs seeking transactions, 21% were below their IPO price of $10. And of 127 SPACs that had announced but not yet closed, 37% were below the $10 price. He calls on government regulators to require the principal who is sponsoring a deal to commit personal capital in it. This will force sponsors to underwrite accurate projections since their capital will be at risk. So of those 127 SPACs that announced but haven't closed their SPAC deal, only 48 of them, so less than half, had some form of sponsor investment, and only 10 of the 127 made a long-term commitment to the company. So calling out some of these SPAC deals that have been announced and the fact that the sponsors not putting in their own capital, also talking about, pipes and saying that the pipe investors need investor protections and having the ability to change the terms of the deal if market conditions change. We saw that already once this year where a deal got renegotiated to a lower price. And then we also have had several come out and say that maybe they don't get the deals done because of the valuation. So, Spencer, there's a lot in here to take away. My keys, and I'm sure people are thinking on the back burner here is, well, what about Virgin Galactic? Yeah. Right? SPCE, Chamath, he had a investment in this company through his SPAC, Social Capital, Sophia, and also he put in his own personal money. Well, earlier this year, it was revealed that he pulled his personal money out of the company. So he himself, taking out that personal investment, and then also one of his SPAC deals, Clover Health. I mean, this is one that's been hit hard since it completed its merger, and it's been the subject of short attacks, and also they've lowered their projections several times. So he didn't really hit on it in his op-ed, but one of the things I don't love about the SPAC deals, right, Spencer, and we were talking about this, is, a traditional IPO, you can only share your past, right? You can't talk about the future projections. A SPAC deal, you can talk about your future as far out as you want. So, some of these SPACs have revenue projections all the way out to 2030, 2035. I think that needs to stop, right? I mean, how far out can you really project? And we have so many of these companies, Clover included, where they go public and then they change their guidance. So that investor presentation that SPAC people saw, it just becomes worthless because those numbers are no longer accurate. I think Chamath is going to take a lot of heat for this because it seems like maybe he's guilty of the same things. The one thing I will note is on all of his SPAC deals, he did put in his personal money along with his SPAC. That was one of his keys that he has talked about. And as he noted, we have not seen everyone else do that. So, Spencer, I rambled for a little bit. What are your thoughts? Tell me what you think of this op-ed and maybe what you think needs to change for SPACs going forward.
Oh, I agree with you about that. I think we all agree about the projections thing. I think I can understand if people are annoyed at Chamath from a hypocritical perspective, because the guy just benefited greatly from the way the system was set up, and now he's saying, well, maybe we need to change the rules a little bit. It sort of reminds me of Joseph Kennedy, who made his fortune on things that he later made illegal when the SEC became a thing after the crash in 29. So here's a guy who benefited from the system and is now saying, well, maybe we need to change the rules a little bit. So I get how people could roll their eyes at that. What I don't get is the anger at Chamath for selling or doing anything. He has one obligation, and that's to his investors, right? If you're mad at Chamath because he sold out of Virgin Galactic or because Clover Health hasn't done well. First off, Clover Health is far from an outlier. A lot of SPACs haven't done well. If you're mad at him about that, you're missing the point. I think Chamath owes you and me absolutely nothing, right? He has a responsibility to his investors, and that's who he has to answer to. He doesn't have to answer to the public. The fact that he was like anointed this like king of the SPACs, I mean, he definitely leaned into that hard, right, and enjoyed the attention while SPACs were in favor, but they're not now, and he's pulled back from the spotlight, which you can understand. So in that sense, it's sort of like an eye roll thing. Like we saw you on TV every week 6 months ago. Don't see you on TV much now. Where you been? But at the end of the day, his obligation is to his investors and to no one else. So if you're mad that he's selling out of one company and doing something else, tough, really. So that's really my point, right? Is
do you think
I understand being like rolling your eyes at this because now you want to change the rules after you just
I was gonna say, do you think the timing is weird at all on this? Because you mentioned he used to kind of be the anointed king of SPACs, right? That he was on CNBC all the time, and it really seems like since SPACs started downtrending and Clover got attacked, he kind of went silent for a while. I mean, he had the occasional tweets out there, including the famous one, I'm going to F some shit up or something. And then the market tanked, right? But anyways, and now all of a sudden he's got this op-ed out kind of calling for regulation. And I think that's where, I have a little criticism, is it's kind of like you said with Kennedy, it was working great for you for a long time.
It worked. Right.
Why the change needed now when, your own SPACs are starting to do bad? And, I mean, I didn't have a huge problem that he sold out of Virgin Galactic. He still owns a piece of it, right? It's not like Social Capital sold all their shares. That was Chamath's personal stake that he sold. So he still has an ownership stake.
Sure.
He's still the chairman of the company, right? Like he still runs it. But I just think it's weird with the op-ed today, especially with the SEC already, diving in. They're already working on it. I don't think they need Chamath to tell them what to do, because I don't think they're necessarily going to listen to him.
Right.
I mean, in my eyes, I think we need to stop with the forward-looking projections, more than, let's say, 3 years out, maybe two.
Two.
We need the pipe investors, the founders, that they need to have more skin in the game, and it needs to be a tighter lockup, right? So a traditional IPO, you can't sell your shares for 6 months. Maybe with SPACs, you can't sell your shares for 6 months, for 12 months, or until they hit a certain point, right? We've seen that with several of these deals where your shares you can't sell until they reach certain milestones, like $12, $14.
Yes.
And then the other thing I don't love as someone who writes about SPACs is when the press release comes out, it almost never has the amount of ownership for the company. So like, let's say XPOA on their SPAC deal, shareholders of XPOA are going to own 28% of the company after the deal, I think. Don't quote me on that. You have to go to the investor presentation to get that information. One of the things I've called for changing is put that in the press release. Lay out right in the press release that everyone can see, so-and-so is going to own 20%, so-and-so is going to own 40%, so-and-so is going to own 60%, etc. I think there needs to be more disclosure there. Those are my things I think need to change.
Yeah.
But again, I'm not the SEC.
Right.
I'm not Chamath, but that's what I see, for the market.
Right. And there's something I wanted to add. Oh, yeah. We should also mention that Chamath put his annual investor letter out yesterday, if you want to check that out. Not a bad read. I was able to skim it. I didn't read the whole thing. Obviously, he's like talking up his performance compared to the S&P 500, which I don't know if that's like the best comparison. But yeah, I mean, I think he's learning the hard way that it's all fun when the market's going up and you're the influencer, but when you're an influencer and the market's going down, it's maybe a little bit less fun. We've tried to get Chamath on the show. We're going to keep trying. I definitely understand the frustration. People are pissed, right? Because SPACs in general are out of favor, and this guy was out, pounded the table on SPACs, every day on TV last year. So I get it.
I think he really just gets so much hate for Clover Health. Like, that's really the one. I mean, if you look at the rest of them, right, like Open Doors trading like 20 or 18, IPO even this week, right, is hitting, $20 going into that.
Yeah.
Virgin Galactic, I mean, yeah, it's come down, but it's still over $25. I mean, that was a $10 deal. The original investment, and a lot of his pipe deals he's done quite well on too, right? MP Materials, ACTC, and others. So it's not like he's had a ton of losers. It's really Clover Health has been the huge outlier, and it also was one that Twitter and other groups really got a hold of, and then they became really mad when that thing fell. So
Yeah, and also one thing that we can't really understand is like it's probably like, if I can curse for a second, it's probably like a big mind fuck to be like basically overnight find yourself as like this massive influencer, right? And like have like, because obviously he's known in the venture world. He was early investor in Facebook. People knew who he was, but his popularity just exploded like seemingly overnight. People were worshiping him. That's probably like a big like a really weird thing to go through just mentally. And he put out some like really weird stuff, like videos and stuff, and like said some like weird things. It's probably just a big mind fuck, honestly, to be.
Yeah, and Cole in the chat saying his mouth has caused a lot of these problems. I mean, like I said, Chamath had a couple tweets, kind of almost guaranteeing that something was going to happen, or the tweets talking about his performance.
Yeah.
So maybe that's rubbed people the wrong way. And, I just, there's a lot to unpack, from Chamath as an investor, from this op-ed, and I knew this was going to lead to a good discussion. I'm happy to have you on, Spencer, today to, be part of this. There's just so much to talk about with Chamath and with these SPACs. The other thing is we have IPOE, doing their deal tomorrow, and then we have IPOD and IPOF both searching for targets still. IPOF was rumored with Equinox, the gym company, the Pure Cycle, the yoga brand, but otherwise we haven't heard a whole lot. Remember, Chamath was going to bring SPACs IPOA to IPOZ to the market, and he actually filed his next 6 or 7. So IPOG, IPOH, they've been filed with the SEC, the tickers, and to where they could launch in the future. Obviously, there aren't a ton of SPACs going public now, but I feel like, there's a lot of pressure on him to nail down a big deal for IPOD or IPOF, or when his new SPAC's price, he's not going to get that premium that he once commanded, where so many of these SPAC units are trading at $10 or below. So it almost seems like with this op-ed, like he said, he wants to bring the prices of SPACs back up, and he thinks his plan can do that. And, maybe he's right. Maybe he's got some points. So, and guys in the chat, I mean, what a lively debate too. It seems like a lot of people enjoying this. So we might have to do this again on a future show and talk more about Chamath. But Spencer, before we go, I do have to say for housekeeping, we do have another interview tomorrow.
Yeah.
FRX, Forest Road Acquisition. We're actually interviewing the founder and CEO of Beachbody, the company going public with Forest Road Acquisition. This has been, one that's not performed the greatest. I think it's below $10, but it's been a hot one out there for FinTwit, widely covered. They are merging with both Beachbody and then also MyX Fitness, which is seen as a possible rival to Peloton. And while I don't necessarily think, hey, they're going to take, all the Peloton's lunch, I think the combination of an at-home workout brand like Beachbody, a connected bike, and also they have a nutrition supplements business. I think if you combine all those things, maybe you have a great digital workout ecosystem going forward.
I just want to say, if he doesn't take off his shirt during the interview, I will consider it a failure. I will consider the interview a failure if he does not take off his shirt, or if he does take it off and he does not have a beach body. And both of those things will annoy me if that doesn't happen.
Maybe you need to join the chat tomorrow, and that can be our chat questions. User Spencer here says he'd like to see your shirt come off.
Maybe I should.
But anyways, guys, it's noon. Another great show here. Guys, please smash the like for Spencer for filling in 3 days in a row. For my man Mitch, we'll be happy to have him back. But what a great, thing that we can keep the show going even when Mitch is out, because I've got Spencer, who's always more than willing to fill in. And, we did some interviews together and they were great. So thanks again. And, remember that Benzinga Pro, $9.97 a month. With the code 30 days. So keep an eye out. There it is on the screen. Perfect, Spencer. And join us again on SPAC's Attack tomorrow, Beachbody. And stay tuned. Power Hour's got some interviews coming up as well. So
yeah, actually, Pat, we're keeping the esports theme going today because we got two guests. We have one on in a couple of minutes. First up is the CEO of Radcom, their 5G play. But then at 12:50, we're going to have the CEO of GMBL. If you're into gaming, you know that one, GMBL, Esports Entertainment. And he's going to be on, Grant Johnson is the CEO. He's going to be on with the Vice President of Marketing for the Cleveland Cavaliers, Matt O'Brien. So we're talking esports.
Yeah, they just signed a deal with the Cavs, right?
They did just sign a deal, exactly. So GMBL at 12:50, RDCM at 12:05. Both of those things on the Power Hour coming up right about now. Right about now. So this stream is going to end. We're going to redirect straight to that. You won't have to do anything. And Chris, always a pleasure, sir.
Yes, thank you, Spencer.
Good job today. And the Power Hour is coming up right now, a minute or two.
Thanks, everyone.